This is going to be the most important break of structure video that you watch in your trading career. We are going to learn what break of structure is, how to identify it, and then how to actually apply it to your strategy and make money in the markets. So what is break of structure? Well, it's quite literally in the name. It's when structure breaks on a chart, where you have candles that break through key levels or zones that indicate that there is now a change in the directional pattern of which way the chart is moving. In order to understand break of structure, you first need to understand the three types of ways in which the market moves. So the first way you're going to have, it's what's called an uptrend. An uptrend is defined as having higher lows and higher highs. So here you can see the low, the low, the low, they're all higher. So you have higher lows identifying that you're in an uptrend. You also have higher highs. So the high parts of the chart are going to consistently remain higher than the other. That's going to be higher highs. That's how you identify the uptrend. Now, conversely, you have what's called a downtrend. Now, a downtrend will look like this, where you have lower lows. As you can see here, each low is now lower than the other, and lower highs, where the highs are now lower than each other coming after. So lower highs. The third and final consolidation pattern is what you will see. So you have a resistance and you have a support. In between, the market is just consolidating, moving up and down between zones, not breaking above, not breaking below, but just consolidating. Those are the first three types of movement that you need to identify and understand in terms of market structure to move on to identifying break of structure on your charts. In order to continue to identify break of structure, we need to understand what a high or a low is. So if you have a chart and the top is here and the bottom is here, when you get a rejection of a high, you'll see something like this. Whether that's a candle wick or a full body of a candle, you will get some sort of rejection letting you know that you're coming down, or you will blow past it and go past the resistance point here of the high of the chart. Conversely, on the bottom here, you will have a low at a support that is either rejected or blows through and continues going toward the downside of the chart. So identifying a high and a low is very important. This is the highest part of the chart, the highest that price has been in the capacity or time that you're looking at it, and the lowest point of the chart in the time that you're looking at it is going to be down here. Being able to identify a high and a low point is not something that everybody gets correctly. So when you are doing this, you need to zoom out on a higher time frame. Typically the 4 hour is what I use. You can use the 1 hour if you're scalping, but when you're looking at high time frame highs and lows, it is very important to get the basics down to identify where the break of structure is coming after you've identified the high and the low. Now let's test this theory and actually identify a downside break of structure. So what we're going to do is find our high like we talked about. Our high is going to be right here, our localized high, and our localized low is going to be right down here. So now that we've identified those two, we can find where the break of structure is. As we talked about before, the break of structure is when the low is broken with a full candle closure. So what we had here was a full candle closure below the previous low in the zone that we are looking at to trade in. So the white box is the entire time frame that we're looking at to trade, and the low was broken here. This was your break of structure because it broke straight through this zone. Now, to make it a little easier, what I like to do is actually draw another key level on the chart, just like this. So here was your support, there was your break of structure, and there's your new resistance. So the way to trade this is to wait for the break of structure to confirm. Again, we saw the lower candle close below the previous low, full candle closure, not a wick, not to be confused with a wick, and we waited for it to retest what is now the new resistance. So at one point this was a support, we had the break of structure which changed the direction of the chart it was no longer rebounding off this. It didn't come back up and rebound there. It actually broke down through the previous support. Now that we broke down through the previous support, we waited for the new candle closure underneath the previous support. Now that we've identified those, we can wait for a rejection at the old support, which is now the new resistance. This is when you would look to enter a short position with a very tight stop loss right around the last key zone with your bottom area, your low that we identified as your target. That's how you identify a downside break of structure. Now we can look to identify a high side break of structure. So again, let's go back in and mark out our lows and our highs of the current time frame that we're looking at. There's our low and there is our high. And we have a localized key level right about here where our break of structure happened right here. So how do we identify that? Let's take a look here. So this is our previous high. We need a full candle closure, not a wick, a full candle closure above that area. So where did we get that? We got that full candle closure right here. So after we saw this break of structure, you have your BOS up toward the upside because the candle closure was above the previous high. We could look to take buys. So we had a full candle closure right here. And now we wait for the retest on the downside. So we're retesting what was the old resistance, the new support. Again, because it rebounded and came back down this way, it was a resistance here. We had the break of structure that came straight through our old resistance and is now used as a new support, again, right over here. Now that we've found the new support, let's go ahead and get in a long position. After we see this big wick rejecting our new support and a green close above the key level, we could look to take longs here. We'd put a very tight stop loss below the previous low of that candle. And we could look to take longs up toward the top here now with a very tight stop loss, a good risk to reward ratio. And that is how you identify a break of structure toward the upside. Now that we've identified how to actually find a break of structure, whether it's toward the upside or the downside, we need to talk about fair value gaps. So fair value gaps are a 3-candle pattern. If you notice here, I have one already drawn out for us. What this is showing right here is the difference between candle number 1 and candle number 3 open and closure. So let's dive into that. The low of candle number 1 was right there. The high of candle number 3 was right here. The difference is known as a fair value gap. The fair value gap is very important because it can be used as a support or a resistance in favor of the direction that the chart is moving. So on my strategy, I use not only the BOS here as a confirmation and a trend change, I actually use the fair value gap as a new resistance or support. In this case, not only did we have the break of structure down here where we closed lower than all of our previous lows, but we also had a fair value gap formed on a 3-candle pattern where the low and the high of those 3 candles created what's called a fair value gap. So what's important about a fair value gap is understanding that once it's rejected is when you can get in the trade. Now that we've identified that this fair value gap is valid and aligns with our previous support, which is now a new resistance, that is another confirmation that we can now use to say, okay, we're going to take a short position here, make a tight stop loss right above the fair value gap or above the previous key level that's now a resistance, and take sells toward the downside, which we've identified was our low of the chart. So a fair value gap is just another tool in your arsenal that you could use to confirm the bias of the chart, whether it's going up or down, whether you're looking to take a buy or a sell. We also have what's known as a bullish fair value gap. We just talked about bearish fair value gaps where it was red. Now we're going to look at a green bullish fair value gap. So same concept here with the support and the resistance. We don't really need to go over that again, but here's our high, here's our low. We have our localized support / resistance right here. And what we have here is a fair value gap that was retested. So not only did the chart have the break of structure that we talked about right here, where it broke through, the previous high was broken with a full candle closure above the previous high. We had both of those, but we also had a fair value gap formed that was between these three candles. So this was a candle and this was a candle. So in the three candle pattern, the high of candle number 1 right here and the low of candle number 3 right here was used to create this fair value gap right here. Now we came up and broke structure and came back down to retest the fair value gap, where you could now take a long position if you wanted to right here after the retest, keep your stop loss right at the fair value gap and take buys toward the high side, again netting you a very good risk to reward ratio, and using the fair value gap, in this case a bullish fair value gap, as a support for your trade to continue to rise up toward our high point, which was up here. Simply finding highs and lows and identifying break of structure and a fair value gap is still not enough to take the trade. And this is where most traders make mistakes, is they forget the 5th or 4th confirmation. So the last confirmation that we use to identify break of structure is what's called an EMA ribbon. An EMA ribbon, as you can see on the screen right here, is quite literally a ribbon. It is comprised of EMAs from 20 to 50 in 5-day increments. So that's going to be the 20, the 25, the 30, the 35, the 40, the 45, and the 50-day EMAs. So I use those in combination to create what's known as an EMA ribbon. Now, the EMA ribbon is another very good tool to use to identify the fair value gaps, the break of structure, which is a change in trend, and as well as key entry points. So we're going to take a look at this chart right here. We'll actually look at it on the 1 hour first. So on the 1 hour time frame, we identified our highs, our lows, our break of structure, and our fair value gap was there. But this time we now have an EMA ribbon. So when the EMA ribbon starts to flip, as it did here, so it flipped to the upside, meaning the yellow, which is the 20, flipped above the 50, we had an uptrend. Now conversely, we're starting to see the yellow flip below the white on a downtrend. Typically, when you see a break of structure, like we did here, the break of structure, the retest that we're looking for is not only at the fair value gap, but also at the EMA ribbon. So we now have two different areas to retest, which happen to be in the same spot. When those two are in the same spot, we have a very, very good chance of, once the rejection happens, that this chart sells toward the downside. Now, this is a trade that I am actually in right now, so it's a really good example. Again, the EMA ribbon is being served, we're going to move to the 15-minute chart here to give you a good example, as a fantastic resistance point here. So the break of structure occurred when the previous low was broken and we had a full candle closure below it, as we discussed earlier. Now we had the retest. After the break of structure occurred, we had a retest of the EMA ribbon. A fair value gap was formed on the 1 hour. If we click back over here, see your fair value gap right here, your FVG. But on the 15-minute, it's retesting the EMA ribbon. Once you have a retest on that EMA ribbon, you can look to enter. We entered right here on a even smaller time frame when we had a retest of the EMA ribbon right here. So as you can see, going back to the 1 hour, our retest on the EMA ribbon and retest on the break of structure and the new resistance and the fair value gap is a perfect storm to have a sell side position. And again, to go over those rules and simply put, we've identified the high and the low. We've identified the break of structure by drawing what was an old support and finding the new resistance. We waited for it to test the fair value gap that was created, the 3 patterns, with this candle being candle number 1, this candle being candle number 2. The difference between the two is what's known as the fair value gap, which was formed right here. We have now identified all of those things and retested the localized new resistance to now take sells. The break of structure is an extremely powerful tool when utilized properly with all 4 of those confirmations. And with that, you now have all 4 confirmations you need to identify a break of structure, execute it, and actually get into a position on your charts. Now, if you guys learned something or you liked what you saw here today, please make sure you like and subscribe to this video, subscribe to my channel, and make sure you turn notifications on. I go live and stream live with my own capital for you guys every single night from Sunday to Thursday. Make sure you subscribe, and I hope to see you again soon.